So first-time home buyers,
Yes.
we love to work with first-time home buyers.
We do.
What is the basic home buying process?
So the basic process is, from a lender's perspective, is we're going to get your financial picture in the beginning.
Mm-hmm.
Okay, so I'm going to find out what type of work you do. What is your income? Okay, I'm going to look at your credit. I'm going to soft check, but I'm going to look at your credit with a soft credit check. And then I'm going to look at your monthly liabilities, what's on that credit report, and what are your monthly expenses. Okay, that is a snapshot in time of your credit, your income, and your expenses. That, along with how much you want to put down.
Mm-hmm.
Okay, we're first-time buyers, so that's pretty much going to be all owner-occupied properties. So how much down? That tells me what you can buy and what you're approved for. And I need people to understand, and where people don't remember, is that snapshot that I took, that I approved you with. As a lender, we will make sure that that stays the same or better all the way to the day of closing.
Right.
You and I both see this constantly, where somebody decides they're going to buy a new car from the time you started to the time they close.
Right.
A common mistake we both see is the no interest, no payments for 6 months. It's real tempting to say, I'm going to buy that furniture, I'm going to buy that refrigerator, and I don't have to make any payments or any interest for 12 months before I close on that house.
Or the pay in 4.
Yes.
You can spread it over 4 payments, no extra interest.
Yes.
Yes.
We see those, and that's going to be, it's going to factor into the approval process.
Right.
2 things to remember on that. One, yes, it can make or break whether you even qualify. The second is, I've got to verify that. And just a heads up, and you've seen this too, it is not easy to verify what that payment's going to be on the no interest, no payments for 12 months.
The paper trail can be a bit traumatic.
Yeah, and we still have to count that payment against them. And Kathy, do you want to share kind of what we see when we ask for your bank statements and we're trying to verify your funds to close? One of the fun things we see on those bank statements?
Yes. One of my least favorite 6-letter words is Klarna. So what happens is Klarna is you can buy anything and everything online, pay in 4, pay in 10, pay in 12 installments. The big draw is there's no interest, easy payments. It's all online. So it doesn't show up on a credit report, which we've already looked at and approved a sales price and loan amount for our buyers. But those Klarna debts show up on the bank statements because those are automatically deducted, and we'll see that pattern and we'll see that show up on the bank statements. So then what happens, as soon as we see one Klarna, or in one of my clients' cases, 10 Klarnas, we have to paper trail all of that, all of those payments. So if you're pay in 4 or pay in 6, we don't have to count the debt. But if it's pay in 10 or more, that's going to add to the debt to income ratio. But whether it's the short form or if it's the long form, we have to have the documentation behind that, which is hard to get because it's all online.
Right, and it's hard. So just because somebody says it's paid off in 4, they still have to show us the paperwork.
We have to show the underwriter that it's just pay in 4, and there's actually a note for each one of those, like a mortgage note, but a note for the debt. And then we have to see the payment history to show how many are left. And again, it's not easy to get.
Fun times. And that can lose you your house.
It can. So for those first-time home buyers, when they go under contract, what are 3 things that we see first-time home buyers do that can really hurt them in the long run?
Probably number 1, top of the list, is taking on new debt. So part of the process is lenders are required to make sure your debts have stayed the same or better from the time you started to the time you close. And we will monitor your credit for new debts and new inquiries, and we will see that pop up that you open a new account. And it's twofold. 1, it's a new debt, so I got to make sure you qualify. And 2, I got to get the paperwork to verify that new debt, because I saw it's an inquiry. I saw somebody was going to give you a line of credit. You got to give me the paperwork to show that, and that can be tedious and frustrating for first-time buyers.
Right.
The second that we see is job change. It is amazingly surprising how often 2 days before closing We go to verify that you're still with that employer and you quit that job and you started a new job and you didn't tell us you were doing that.
Right.
So again, we will verify that you're still with that company, still making the same amount of money or more before closing. The third thing that first-time buyers make is large deposits. If there is a large deposit and we see that as part of verifying your funds to close, we're going to have to ask what that is. So Aunt Sally may think she's doing you a favor by giving you $10,000 to help you buy that house and put it in your account. We've got to figure out where that came from. I got to make sure you did not just go out and get a loan that we don't know about that has a monthly payment. So when you make that large deposit, it may have the best of intentions, but it can be cumbersome to try and prove where that came from. So kind of just to tie things up, Kathy, I think you would agree with me on this, it is as much as we preach the mistakes that first-time buyers can make, and please don't make those mistakes, they're going to happen. The mistakes are going to happen. So as you and I have talked to before, when that happens, what now and what if? And so when first-time buyers do make those mistakes, having everybody local in our office and the years experience that we have is we still get through them and we still get the deal closed and get it closed on time. Everybody's happy at the end.
I would agree. Absolutely.